Good morning, everyone. Thank you again for coming to the FEI breakfast. My name is Rob Miles. I'm the team leader here at the Commercial Bank. Me, together with 8 of my relationship team members here on the island, care for the middle market banking needs of the customers in Nassau and Suffolk County. Customers with revenues ranging from $10 million to over $1 billion. We're honored today to be a sponsor of the FEI event, and more so we're thrilled to be able to support the Long Island chapter for the Leukemia Lymphoma Society. It also gives me great pleasure to introduce Michael Puglisi, an economist with Wells Fargo Securities. Michael today is going to talk about the 2019 economy and what may lie ahead for us. Based in New York City, Michael covers the U.S. economy with the primary focus on fiscal policy. He plays a lead role in producing the bank's U.S. and international forecasts, interest rate forecasts, that is. His work has been featured in the Wall Street Journal, on Politico, and in Bloomberg News. And without further ado, I'd like to introduce Michael Puglisi.
Thank you, everyone. Good morning. Again, my name is Mike Puglisi. I'm an economist here for Wells Fargo. So we're going to cover a couple different things. We're going to talk about the U.S. outlook, the outlook for growth, for the global economy. We'll talk a little bit about the regional economy. Maybe we can talk a little bit about local infrastructure and the train system here in New York and Long Island. I think that could be a good topic given the start to today. So, with that, let's dive right in. I'm going to start for about half an hour or so. I'm going to try to leave some questions at the end. So. There's a lot going on in the world right now between Congress, China, the central banks that are moving all over the place. So, there are a lot of different topics I could cover. So I want to leave plenty of time at the end for anything that I might have missed or anything you want to cover a little more deeply. So with that, let's not waste any more time. Let's dive right in. So what's going on in the U.S. economy right now? I mean, if you look at a lot of the data, things look pretty good. You've got the number of full-time jobs in the U.S. economy, so this isn't just total jobs, this is full-time employment. Almost 8 million jobs above where it was back in 2007 at the last peak. You've got the more narrow U3 unemployment rate that you see in the news all the time, back to pre-recession lows. The broader U6 or underemployment rate that includes people who work part-time for economic reasons or maybe left the workforce because they're discouraged. That's pretty low. You look at things like consumer confidence, business confidence, all of these near cycle highs. And yet you hear all these concerns right now about a global growth slowdown or recession, or you saw equity markets take a pretty big drop there in November and December and maybe a little bit to start this year. So what's going on? Well, I mean, it's pretty clear that the economy has accelerated over the past couple years. And if we think about what the drivers of that acceleration are, we can ask ourselves, well, are they likely to be in place over the next year or two? Or are they likely to fade? Because if they're likely to fade, that maybe raises a good point about are we likely to see a slowdown in growth, and then what that translates into for Fed policy or equity markets, or kind of pick your financial market instrument. Well, the first challenge is that global growth has been a big driver of faster growth in the U.S. You can see on this chart right here, this just shows the global economy last year was probably the strongest it's been in the last decade. And real export growth in the U.S. has picked up in line with that, where you've seen export growth in the U.S., that's the best it's been in years. It's one of the many ironies of this recent trade debate. We'll talk about trade a little bit later. But you're seeing faster growth in the U.S. because of a better global economy, even though you've got all this trade discussion about how trade is bad for the U.S. The challenge is that even as the U.S. has accelerated, you can see the U.S. growth here on that blue line, other economies, particularly other advanced economies like Europe, like Japan, like Canada, they've started to slow. And so you haven't seen that same boost in recent quarters that you were maybe seeing in 2017 and 2018. Okay, so maybe that one leg of the pillar doesn't look as good as it did. What about oil prices? Oil has become kind of a funny thing in the U.S. right now, where historically, right, it was a very straightforward relationship, where high oil prices were bad. It meant that it had less money for the consumer. Low oil prices were good for the obvious reason that now people had more money to spend on other stuff. Now we've got more of a seesaw type relationship, where you need oil prices high enough to spur production in the U.S., because we are now the largest oil producer in the world, as hard as it is to believe. You can see on this chart here to my right, your left, that's US oil production in the United States over the last, call it 10 to 15 years. It's just simply skyrocketed, notwithstanding that one decline we had from the big drop in oil prices a few years ago. The other chart is just meant to show what are oil prices, what are gas prices doing to overall inflation in the economy. Well, you know, it's picked up some, but it's still pretty low, where for most of the past couple of years you had this Goldilocks level, where you had oil prices that were high enough to spur this rapid growth in output, but not so low that you weren't getting all the production, and vice versa, not so high that they were taking a big bite out of the consumer, and not so low that they were a huge boom. So they kind of hit that Goldilocks level. The challenge or the concern is that back a few years ago when we had oil prices drop significantly, business fixed investment just completely flatlined. Pretty unusual to see that outside of a recession. So the concern is if oil prices drop a lot, are they no longer going to be in that Goldilocks level for the booming oil industry that we've got in the United States? And then finally, the big driver of growth again has been fiscal stimulus. Either the tax cuts for big businesses, for small businesses, for individuals. You've seen a very unusual pattern recently where you've seen the budget deficit expanding in an environment of accelerated growth. I mean, typically the deficit follows a very standard pattern. There's gray bars there, recessions. So you see the deficit kind of grow or expand during a recession when economic activity is not any good, and then you see it shrink or maybe even go into surplus when times are good. Now you're seeing times good, but you're seeing a growing budget deficit, which again, very, very unusual. And it's kind of hard to overstate this. So this is just another way to look at the data, where you take the US and you compare it to a bunch of our counterparts. So different parts of Europe, Australia, Canada, Japan, other major economies. You look at their budget deficits relative to the size of their economies, and we have the biggest one. I know that's pretty hard to believe, and maybe those countries have more debt, but the growth, right, the flow, the deficit side of things, really pretty substantial. Now, I think something folks kind of struggle with sometimes is, how do you hold these two different ideas in your head? More debt now can mean faster growth, right? Just like if you put something on your credit card today, that means you can go on vacation or you can buy a bigger car or whatever. But then there's a risk down the road that that's going to mean slower growth. I think what folks struggle with sometimes is this idea that you can have a large deficit in the near term that gives you faster growth, but that's going to cause problems down the road. But when you think about, is that going to be there moving forward, it's kind of a one-time thing. I mean, if you think about this just from a year-over-year standpoint for your company, you know, you've got great earnings growth of 10, 20, 30% as a result of the tax cut. You're looking at things this year and you're saying, well, my year-over-year comps maybe not quite as good. Economic growth works very similarly. It's a growth-based measure. You're comparing yourself now to a much higher base. And so if you're saying to yourself, well, maybe we were growing 3% or 3.5%, why can't we continue to grow that? It's for the same reason that maybe your company can continue to earn 30% on an after-tax basis year in and year out. You kind of get this one-time injection, the level goes up, and then you start to level back off in growth terms. You're seeing that from this fiscal policy side again. What is going to be the factor that keeps us going at these levels? So that's a pretty bearish outlook. Right, and I don't mean to be too bearish. We're not calling for a recession or anything like that. You might be asking yourself, why? You know, why aren't you calling for a significant drop-off in growth? Well, a lot of those things are recipes for slower growth compared to what we've experienced over the past year or two, but they're not necessarily indicative of a giant explosion like we had a decade ago. You look back to 2014, 2016, when you had this big drop in oil prices, there were concerns about global growth, there were concerns about the energy sector. And what happened? Personal consumption held up really well. I mean, shocker, right? It's a good thing when oil prices come down and people aren't paying as much at the pump. And when you're talking about the sector of the economy that's 60%, 70%, and that's a pretty meaningful number. Wage growth, another one for the consumer sector. This is just a simple chart, nothing fancy, nothing complicated. This is just a simple chart of wage growth in the United States. We're coming off a pretty low base, and it's taken years to get higher. But you can see over the last, call it 3, maybe 4, maybe 5 years, there's a pretty clear upward trend. So you pair this wage growth that's picking up with lower oil prices and then maybe lower headline inflation. You're getting faster real wage growth, and you're getting a pretty solid consumer sector. It's hard to have a recession in that environment. What about leverage for the household sector? Similar thing. This just says what's the household debt to income ratio, basically in the US, or debt to GDP ratio. It's fallen. It's the lowest it's been in, call it 20, 15 years or so, something like that. we're not nearly as levered as we were from the household side as we were, call it 2005, 2006, 2007, when folks again had some of these late cycle concerns. Savings rate, same thing. Household saving rate about double right now where it was in 2005, 2006, 2007. That gives you capacity to deal with some type of unexpected development, like a giant jump in oil prices like we saw back in that time period where we had oil skyrocket to $140 a barrel, and you maybe had households that were kind of living on the edge during this housing bubble, and that was enough to push them over the edge of their teaser rate mortgages. You're not seeing that right now. I mean, household savings not where it was in the 1960s, but that's an entirely different conversation, neither is our infrastructure, unfortunately. But again, that's a different topic and a different presentation. The corporate sector, maybe not quite as healthy as we'd like it, but not terrible either. We put an index together that kind of looks at everything from interest coverage ratios to how much of your debt is short-term debt, what does your liability profile look like. It's okay. It's suggesting mid to late cycle. It's not as bad as it was, say, in the late 90s or the early 90s before those recessions. It's about where it was in the mid-2000s, but that was more of a household-driven leverage issue. So it's not bad. It's a risk we're monitoring, but if it's something you see in the news, it's not something we're overly concerned about. Financial sector, least amount of debt it's had in the last 20 years relative to the size of the economy. So there just aren't a lot of these big leverage issues that we've seen prior to previous cycles or previous recessions, and you pair that with a consumer that looks pretty healthy and pull it all together, and for us it's an environment where, yeah, the economy's slowing. Maybe that means we're not going to see the 20% gains in the equity market we've seen recently. Maybe it doesn't mean that we're going to see Fed funds hikes of 4 like we saw last year. But it's not an environment where growth is going to fall off a cliff or we're going to have a giant housing bubble implode on us or anything like that. It's an environment where we end up back maybe later this year to where we were a few years ago. Growth kind of muddling along in 2.25. I know that's not nearly as exciting as it would have been if I was giving this presentation a year ago and the S&P 500 seemed to go up every single day, day in and day out for the better part of a year or two. But it's also not a doomsday type situation that I bring to you. So I guess it depends on if you're a glass half full, glass half empty kind of person. So that's the growth outlook. Let's kind of step back now and talk a little bit more about rates. So the flip side of all of this, all these deficits and the Fed continuing to unwind its balance sheet is, well, what does it mean when the government runs a really large deficit, right? That means it's issuing a lot of debt. And what is debt? That's treasuries. And that's kind of the risk-free rate against which we measure a lot of stuff, be it a 30-year mortgage or just spreads over corporate bonds, pick your poison. So what you're seeing right now is just a surge in net treasury issuance, maybe double, potentially even triple, depending on how you want to measure it compared to what we were seeing a few years ago. Again, that's very unusual late in the cycle. Typically, you've got the Fed raising rates, but you've got a much, much smaller deficit. That means you've got fewer treasuries being issued, and it doesn't create as much upward pressure on rates. Now you're seeing both. You're seeing the Fed raise interest rates at the front end of the curve, and you're seeing long end rates kind of rise as you see all of this debt come to market. That, for us, is underpinning our expectation for the next year or two that rates are going to keep rising. Not nearly at the pace we maybe saw over the course of 2018, but that we haven't seen the peak of rates either at the front end for LIBOR or for longer dated stuff like 10 or 30-year debt. And this is a global phenomenon. If you net out what the central banks around the world were buying, we basically had a 3-year stretch in there from 2014 to 2017 where there was no new bonds coming to market because the central banks were essentially buying all of it. That's just this flat section here in this part of the chart. We've hit that inflection point. Central banks in the US and other parts of the world are starting to step away. You're starting to see deficits go up in places like the US, and we're getting that organic growth. It's not the kind of thing that's going to show up in a day, right? I feel like we look around sometimes and we say, how did rates get so low? Particularly a couple years ago in 2016 when it seemed like maybe we would be in negative territory just like Europe was. And it's not that surprising, right? I mean, if you go back to your Econ 101, if supply is literally 0 for 3 years in a row, are you altogether surprised that rates aren't going up? That has started to turn, and it's a slow-moving trend. It's a structural trend, just like a demographic one might be in an economic development. But it's something that is worth bearing an eye on. I mean, it rose pretty significantly in 2018. We expect it to keep going up next year. Again, that's a backdrop for us of higher rates throughout not just the US, but throughout the world. Now, when it comes to inflation, I think the one big point I want to make is that employment costs are really the big driver of inflation, right? For most companies, the biggest cost to them are the workers, the labor. And this chart looks fancy. It's really not. It just says on the x-axis, how much slack is there in the economy? The farther right you go, the less slack there is. The y-axis, as you get higher, it's wage growth. And it looks at 3 different cycles. So the kind of green and blue ones are the last couple expansions, the orange ones are the most recent one. We were really in this lower left quadrant for the entire cycle. I feel like I see on the news all the time, I talk to folks, why is wage growth so low? Why is wage growth so low? A big driver of it is we had such a large hole to get out of. It's taken almost 10 years for the most recent data point to get back into even the middle of the last couple expansions. So it just took years before we finally created enough jobs in enough industries in enough parts of this country to actually see the labor market slack start to diminish and start to see the wage growth that we saw on that chart a few pages ago. It's not that the labor market's broken, it's not that wage growth is broken, it's that in an environment where you've seen more slack in the economy than we've had since the Great Depression, and inflation is really low, it's not that surprising that nominal wage growth is going to look slow too. And you've started to see that turn around if you've paid attention to the data. And so then what's that an environment for? If you've got rising costs from tariffs, we'll talk about trade in a few minutes, you've got rising costs from labor market, the labor market continuing to improve and tighten, more rising benefit costs, that type of thing, you're talking about an environment where costs aren't exploding, but costs are rising enough that it's an impetus for the Fed to kind of keep hiking and keep bringing interest rates higher. So for us, we're looking for one more rate hike this year and then a pause from the Fed. So maybe they hike one more later this year. I wouldn't surprise if it's 2. I mean, I don't think that would shock anyone if the Fed funds rate got up to about 3%. But once we hit that level, it's almost a little hard to justify additional hikes out of the Fed. If growth is slowing back towards that 2, 2.25, and inflation is strong, but it's not running away. I mean, oil prices are still fairly low. The wage growth is picking up, but it's not going to the moon. We're not talking about the levels we saw in previous expansions. What is the impetus for the Fed to keep going? Maybe one of them was asset prices were starting to run away or get way too high, but even that you've started to see recede a little bit over the course of the past few months. So again, the Fed outlook for us is maybe a hike, maybe 2 over the course of this year, and then a pretty long pause. Last thing I want to draw attention to on the Fed is the balance sheet. It's probably something you've seen on the news, maybe you've seen it on TV. It's probably going to end later this year in terms of the unwind. It's not as big of a deal as the media make it out to be. Coincidentally, I was on the phone with my dad yesterday, and he said, I have 3 questions for you. How big was the Fed's balance sheet in 2007? How big was it at its peak? And how big is it right now? And I said, well, sadly, I happen to know that off the top of my head. And I said, it was about $700 billion. And then it was about 4.5 trillion at the peak, and today it's about, you can see on this chart, it's 4 trillion-ish. And he said, wow, from the news you would think that the thing has been cut by 2/3. It really hasn't. I mean, it's calmed down a little bit, but the honest answer is the balance sheet's going to be a lot bigger today, and it's going to be bigger for years than it was back in 2007. Some for reasons related to monetary policy, other reasons because the economy's a lot bigger than it was. It's hard to believe in 2007 now was 12 years ago. The balance sheet should grow over time, just in line with the size of the economy. And so it's not as big a deal as financial markets are making it out to be. It's something that will probably come to an end later this year, and maybe it'll even start growing again in a couple of years if growth does continue to slow. But I don't think that is anywhere near one of the big risks in 2019, is this issue related to the Fed ending its balance sheet unwind. So on that note, what are the risks to the outlook? What worries us? What is the big risk maybe to U.S. growth or global growth over the next year or 2? Well, I think a big obvious one is trade. And if you kind of put yourself in the president's mindset for a minute, I know that's maybe a little scary for some of you, but that's kind of the nature of the job to an extent in today's age. You think about some of our big trading partners, China, Canada, Europe, and Mexico are the 4 I grouped into on this chart. And if you can't quite see it, the big one here, that reddish line at the bottom, that's China. So if you're thinking about the trade deficit as a problem, which we can talk about whether it is or it isn't in the Q&A, but for argument's sake, let's say the president's right and it is a problem, it's pretty clear that the driver of the trade deficit is China. I mean, the growth over the last 15 years or so has been significant. You look at Mexico, you look at Canada, you look at Europe, yeah, do we run a trade deficit with them? Is it huge? Not really. Is it growing all that much? Not particularly. The China one has grown really significantly over the last 15 years. And part of it is because they're so big. I mean, they are not as big as the US economy, but they're second to us. I mean, they're nowhere near as big as a Mexico or a Canada. I mean, they're a country with over 1 billion people. So if we say, okay, well, let's just say we've established that the deficit is an issue with China, well, how much exposure do we have to them and vice versa? The answer, honestly, is not all that much in both directions. So you can think about this a couple different ways. What percent of our exports go to them? What percent of our economy is based off of them? From the US side, about 8% of our exports go to China. And that amounts to about 1/2 of 1% of our economy. Not a whole lot. And from the Chinese side, it's about 2% of their economy, maybe 2.5%, and about 20% of their exports. Now, I think there are 2 takeaways there. One, they have a lot more exposure to us than we have to them. And 2, they're still not huge numbers, right? I mean, the flip side of that is more than 80%. So most Chinese exports go somewhere that are not the United States. So yeah, I mean, are these the types of things that could slow growth in China, that could slow growth here? Absolutely. I mean, I don't want to knock 1% of GDP too much. I mean, that's still 1% of a number that's over 20 trillion. So we're still talking about really big numbers. But I think sometimes folks frame it as their exposure is 25% of their GDP comes to the US, or vice versa, maybe 10% of ours, and it's really not true. So again, is it something that could cause growth to slow in line with what we're forecasting? Yeah. Is it going to cause the world to implode? Probably not. That comes with a caveat, because I'm an economist. China has a lot of problems too, which I think folks forget about sometimes. I mean, they don't just operate in some type of like magical land where they have no economic issues either. We focus a lot in the US on demographic issues, the aging of the population, what does that mean for growth, what's it mean for the federal government and the budget. China has the same problem. Their working age population, they find here kind of 15 to 64, so it's a little broader than we usually define it in the US. It's flat, if not outright shrinking. So they're facing some of the same graying issues that the US is. Same with debt. China has seen tremendous debt growth, particularly in its private sector over the last couple decades. The US, kind of here again on my right, your left, our debt growth over the last 10 years has been pretty steady. The composition has moved around, where households have delevered and the federal government's run up a pretty big amount of debt. But the aggregate amount, what that chart is measuring there, you can see it really hasn't changed in 10 years relative to the size of the economy. China, theirs is more than doubled. They're really levered up over there too, and that creates risks for them. How do they borrow more money to invest in infrastructure or continue growth, to continue growth along on a steady trend? How do they pay for things like Social Security and pensions and healthcare and other stuff like that as they continue to advance and develop and want to have a stable society in their own country? They have their own challenges, and I think it's easy to forget that it's not just the US that grapples with these issues as the trade negotiations kind of continue. Another international one, Italy. Real GDP per person in Italy today is lower than it was in 2000. Think about that for a second. If you were born in 2000, so you're what, you're 19 years old today, you're roughly, maybe 18, living standards are lower than they were when you were born. I mean, that's shocking, right? I mean, this is Italy. This is not a third world or developing economy like Venezuela that sees these rapid changes in living standards over time. That's a real challenge. I think we've seen this, it's not just a US thing. We focus so much on Trump and the populism at home, and is he a symptom, is he a cause, what about the other side? And from Brexit, which I haven't even talked about, I'm happy to discuss in the Q&A if that interests you, to the trade negotiations, to things like Italy, which quite literally one of its leading parties right now is being led by a comedian, right? That's not a joke at all. No pun intended. These are real challenges in terms of the struggles facing some of these economies, particularly countries like Italy, like Greece, that have essentially seen lost decades, if not lost multiple decades. Japan being another good example. So another thing to keep an eye on, Brexit leaving the European Union, a really big deal for the UK, a moderate deal for Europe, probably not a huge deal to the US. The UK, just from a global standpoint, is not a huge country. Italy's a lot more integrated into the Eurozone. It uses the euro. All of its debt is denominated in euros. It operates under the European Central Bank. The UK has always been a very kind of funny half in, half out member of the European project. If Europe decides to leave, who knows what kind, or I'm sorry, if Europe decides to leave. If Europe decides to leave, that's going to be a real issue. If Italy decides to leave, then that opens up who knows what kind of can of worms, right? What does Greece do? What do other struggling countries do? Where does that leave Germany? again, that's not the kind of thing that's in our forecast. I'm not saying this is going to happen in the next 3 months, but I really think this is a stark issue, and folks just say, oh, well, Brexit will be resolved by the March deadline or the July deadline, and then we'll all move on. And there are these structural challenges that kind of continue. And if you think things are bad now, just stop and imagine what they might look like in another severe recession. I mean, this is an environment where most economies have been doing at least okay for a while. Coming back to the US, I think, again, these structural issues. Yeah, I talked earlier, job growth is good, confidence up, unemployment down, but there are these structural changes underneath the economy. This just says, how many jobs do we have in each industry compared to what we had in 2007? So if you're above the line, we have more jobs in that sector. If you're below the line, we have less. So in certain sectors, education and health services, leisure and hospitality, a few others, 20, 30, 40% more jobs than we had back then. Look at those bottom two lines. The dark blue one there that's kind of almost back to level is construction. And then the green one there, manufacturing. We still have fewer manufacturing jobs in this economy than we had in 2007. Despite everything, right? Despite the 0% interest rates, the Fed's balance sheet, the corporate tax cuts, the individual tax cuts, the tariffs, pick your poison, it's still been pretty slow growth. So even though the aggregate number of jobs has come back, the industries themselves are still seeing variability. Same from a geography standpoint. Same idea, what's been the percent change in employment by state relative to the peak back in 2007? Some states doing really well. New York doing all right. Darker colors mean more job growth in this chart. So the West Coast, maybe parts of the Sun Belt, used to live in Charlotte, North Carolina, seeing tremendous growth there. You know, parts of the Rust Belt, West Virginia actually has negative growth. So there are fewer jobs today in West Virginia than there were in 2007. Pretty stunning statistic. So you've, again, seen a lot of geographic disparity there in terms of where the growth is concentrated, not just by industry, but also by part of the country. And you can drill down even further. So I did one of these for today on New York. This is a little bit different. So this is the unemployment rate. So it's the flip side. So now darker colors are bad. And you can see, right, closer you get to New York, pretty good, pretty low unemployment. You get up into some of these parts of upstate New York, particularly out in the more rural areas, and you just haven't seen the same level of recovery, be it because of lower job growth or higher unemployment or the mix of jobs. It's a very, very uneven distribution across a number of different spectrums. Geographic, industry, we talk, economists in the news like to talk about the income side a lot. That's very interesting. We can again talk about that in the Q&A, but it's not just that, right? It's geographic, and it's geographic within the country, within the states, within even, some metropolitan areas. So I think that's another challenge because again, we're talking about times that have been pretty good, where you've seen pretty good job growth, you've seen pretty easy monetary policy, you've seen these tax cuts go into place. And now we're looking out and saying, well, growth is going to slow. It's not immediately clear kind of from a thematic standpoint where that faster growth is going to come from. And what does that mean for some of these areas in the next downturn? I think those are real risks and kind of real questions that we're going to be struggling with and grappling with for years to come. So I know it's tough to finish on the risk section because it always ends on a gloomy note, but maybe taking a step back before I answer any questions. So what are we looking for? We're looking for growth to remain positive this year in the US and around the world, but for it to be slower than it has been over the past year or two. That translates into a Fed that hikes, but hikes at a much slower pace than we've seen recently. Big deficits means big treasury supply. Big treasury supply probably means higher rates, not just at the front end of the curve, but really across the entire treasury curve all the way out to longer dated stuff. That's kind of in a nutshell the forecast that we're looking for through the end of this year and into 2020. So I know that was a lot of information over the last half an hour or so, and I really appreciate you staying patient and hearing out all the econ nerdy wonkiness, but I think we've got a few minutes for questions. If anyone wants to ask anything on anything I covered or did not, please, by all means. I know someone must have a question. I've got questions. Maybe you guys have answers. Does anyone have an answer for me? Yeah, did you?
You talk about the steepness of the curve a bit. You talk about a lot of activity from the Fed at the front end, the short-term rates as well as monetary policy, but kind of interested to know what factors may influence the steepness of the curve.
Yeah, the question was kind of, what do you think of the steepness of the curve? So typically in an expansion, right, the curve flattens. The later you get, just a general rule of thumb, the curve flattens as you get late, and then a recession happens and we steepen and wipe right back out. And most people focus on that as a result of the Fed, right? Because it's easy to remember, it's easy to forget. When someone says the Fed hiked rates, what they're saying is the Fed hiked its policy rate, which is an overnight rate, which is a very short-term interest rate. And so what happens, right? The Fed is increasing interest rates over the expansion, short-term rates are rising, and then the deficit's usually getting smaller, right? So there are fewer treasuries, fewer debt, and then you're starting to see this flattening. So it's kind of both sides of the equation. We're seeing the Fed bringing up short-term rates, and 5, 10-year, 30-year notes and bonds, their issuance is coming down and the curve flattens. What we're seeing right now is kind of more of the seesaw, where the Fed is increasing short-term rates, but it's rolling off its balance sheet, which is rolling off notes and bonds, and the Treasury's borrowing a lot of money, which is issuing a lot of notes and bonds, and you're kind of seeing this seesaw back and forth. And so that for us is why you've kind of seen the curve flatten on trend, but it's kind of gotten stuck, where it's not inverted, right? There's still 20 to 30 basis points of slope between 2s and 30s, and it's been kind of stuck in the mud there for months. And I think the big driver of that is the supply story, where that is an offsetting factor to some extent. So for us, we're looking for the curve to steepen, particularly towards the end of the year. Maybe it flattens a little more in the near term as the Fed eventually gets 1 or 2 more hikes in. But past that, we're thinking that the next move, maybe 2020, 2021, is more likely to be a cut than it is to be a hike. And that's the environment you usually start to see the curve steepen out pretty significantly, by whatever metric you want to use, 3-month, 10-year, 2-year, 30-year. But generally speaking, I think our outlook is for kind of no more steepening, no more flattening in the near term, maybe a little bit of flattening in the next 3 to 6 months, but longer term, right, if you ask me this question a year from now or 2 years from now, I would say almost certainly a steeper curve. Any other questions? No? I'm an Eagles fan, so we can talk about Philadelphia sports and the Super Bowl if you'd like.
You say that.
I was born in upstate New York. I'm from Albany, so most of my family are Giants fans. And they would not let me let it down until a year ago. So.
How
All right.
about those trains?
How about the trains? Right, yeah, infrastructure. Maybe I'll finish on that quickly before I step down. I think that's a really great illustration of the challenge of boosting longer run growth in the US. And I'll go back to a chart I briefly skipped because it's a little bit nerdy, but the challenge in a high growth environment, right? I kind of like to use an analogy of companies when I talk about this. If you're a company, and I went too far, if you're a company and you're highly levered, right? It's harder to invest in the business because you're using more money towards debt servicing, or it's just you don't have the capacity to use that free cash flow to build a new plant or buy new computers or invest in human capital training or what have you. I think that's the challenge right now on the public sector side. This is a chart of productivity growth, which basically is just a measure of, right, how productive are the workers in the economy. And that comes from private sector investment, but it also comes from public sector investment, right? How educated are your workers? How skilled are they? How efficient is your infrastructure system that can get them from place to place on time? And a challenge becomes when the public sector carries a lot of debt. It's not that much different than the private sector. You start thinking to yourself, how do we pay it off? How do we service the debt? And how do we restructure it? And all your focus kind of becomes on the leverage side. And it becomes less about, how do I take the money I'm generating and invest it for tomorrow? And that's not just a challenge for the federal government. I mean, you see this particularly in the Northeast, but other states have this issue too, Illinois and a few states in the South. Kentucky's got a lot of pension issues. And so that becomes a real challenge. And then it becomes, when you're using your capital budget to fund operating expenses, you're kind of eating the seed corn of tomorrow. And